Hello, everybody. We'll just give everybody maybe a minute and then we'll begin. Okay, why don't we start? So this is the second out of 4 seminars. My name is Alesh Eisner, and this is Investing Basics. This is for Canadians primarily, even though I think there will be some carryover into Americans. So what I'll do is I'll quickly go over some of the goals that this presentation has. We'll, in about 5 minutes, go over what we covered on Tuesday. This is a completely new presentation, or we're continuing from where we left off previously. So there shouldn't be any duplication other than that review. So what I'm hoping to do is to cover the basics of investing in personal finance for Canadians. I'll cover some simple investing strategies, compare different vehicles and account types, and we'll talk about Canadian taxation today. So that will be fun, but seriously important. Where I think we're all trying to get to is to become financially independent and or saving for retirement. So that's kind of the goal of this presentation or of this series. So what I'd like you to know when you leave after these presentations is to know how to begin investing, to know the basics, and to be motivated to start investing. Sooner the better, and to educate yourself by at least becoming interested, okay? What you want to do is make some decisions as we're going through this and start thinking about, number one, do I want to use a financial advisor? And I'll talk, I think, on Saturday about financial advisors specifically, or do I want to do it myself and use a discount brokerage? If I want to use a discount brokerage, you want to end up paying as low fees as possible. And so do you should sort of answer, do I want to be using individual stocks? Do I want to be using exchange traded funds or mutual funds? And what type of account? And am I going to be making small purchases regularly or making infrequent large purchases? Okay. This is not a get rich quick scheme that I'm presenting here. So please be aware of that. Okay. So what I'm telling you here is not investment advice. This is education. You can call it entertainment if I tell a joke or two. And it's for demonstration purposes. I'm not trying to get you to buy or sell anything. I've been an investor for over 20 years in mutual fund stocks, real estate, and private equity, which is what I'll talk about, I think, on Saturday as well. And keep in mind that I'm pretty risk friendly, that I know sort of what's happening and things don't scare me. That's a personal thing. And so if that's not you, then please invest accordingly. If you have any questions whatsoever, please put that into the chat. I've got it open and I will answer your questions. This is for you. Don't be shy. And if you don't understand something, it's likely that somebody else doesn't either. So as I'm going through this, if you had any questions from Tuesday, please feel free to ask as we're going through what we covered on Tuesday. I'll try to keep this to under an hour and a half like I did last time, give or take, and also be aware this is being recorded and it's going to go on to the YouTube channel. The Tuesdays already has. So my YouTube channel is called Canadian Money Talk. I also run a TikTok channel of the same name, So feel free to go over and take a look on YouTube. I have over 150 videos that I've done over the past year and a bit. So hopefully some will be useful. So, okay, and I should thank my sponsors who are funding the Zoom and the meetup.com licenses, the Oak Avenue Neighborhood Society and Vancouver Foundation's Neighborhood Small Grants Program. And if you have any project that benefits the community, which I'm hoping these presentations do, then please visit their websites. Okay, so moving on. We talked about vehicle definitions. So the big ones would be stocks, shares, or equity, which basically mean ownership in a company, and bonds, which means loans, whether it's a government or companies. And an index is a representation of the market. It's usually 500 different stocks. They add them all up together and divide by a number, and the resulting number is the representation of the New York Stock Exchange, for example. Okay. Mutual funds and ETFs are baskets of investments. They can either be actively managed, meaning a human is picking their components, or they could be passively managed, meaning they just follow an index or some sort of a formula. Bear market is when the market goes down. Bull market is when the market goes up. Recession, depression, I'm sure you've all heard of. These we sort of covered. Different vehicles have different fee structures. So that's why I said, know what you're going to be wanting to do and choose the appropriate brokerage. So if you find out that you want to do an RRSP and you're going to have $10,000 to start, I'm making this up obviously, and certain brokerages will charge you an annual administration fee unless you have $20,000 in your RRSP, don't choose that brokerage. Okay. We talked about risk. Risk is just whether you're able to stomach the volatility. So different investments have different risk profiles, and you have a risk profile, and you need to be matched appropriately to the investments. So basically, are you able to handle the ups and downs psychologically, or are you going to freak out? Are you able to handle it financially? Meaning, are you going to be able to buy groceries without selling something that just dropped 30%? Are you financially educated is another one. The time frame when you need the money back is a very important component, because if you have 40 years, you're going to be in very different investments than if you have 6 months. And then finally, the return that you need. If you need a 30% return a year, you're going to be in very, very different investments that are going to be going like this in order to get you a possibility of getting a 30% return, but you could also get a significant loss. While if you need a 5% return, then you can be in something that just goes like this. So your financial advisor will help you out with that. If you're doing it on your own, you should sort of know thyself. So different portfolios have different risk profiles. The rate of return and volatility, the risk, are correlated. So I got a lovely chart here where you can see that after 60 years, this represents 60 years, what gets the best return also seems to be the bumpiest. So they just go together. Okay. So one thing I introduced was a strategy. It's mostly for retirement, but it also illustrates how different types of investments work. So that's why I included it here. Something called the bucket portfolio approach, where you have 3 buckets of different types of investments. Bucket 1, you have 2 years of living expenses in cash. It's not making you anything. In fact, it's losing to inflation, but it's there if 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 the rest of your portfolio takes a hit, you can live for 2 years off of it. And bucket 2 is sort of a middle ground where you have 8 years of living expenses in high quality bonds or dividend stocks. And then bucket 3 is everything else. So the rest of your portfolio should be in stocks. So bucket 1 protects you from a crash, that you don't have to sell what has just crashed, which will likely be this. But bucket 3 also prevents you from losing money to inflation. And bucket 3 is what's going to make you money over the long run. So this way you sort of have a little bit of everything to kind of cover yourself. Okay. So the index chart, very, very cool item. Let's see, different asset types. So this is just how I sort of defined my world. As you get experience, or you probably have your own view of the world. So investments for me is something that has a stream of income or cash flow. So dividend payers or real estate. Speculation is something that goes up in price, but you need other people to bid it up in order for it to go up in price. So that would be stocks with no dividends, and it could be real estate that doesn't have positive cash flow, but is going up in value, but you need other people to be bidding it up. And then Bitcoin and gold also fall into this category. And then finally, gambling it could go either way. I stressed the importance of starting early, where you can let the compounding do the heavy lifting on your portfolio, and the sooner you start, the better. So $1 after 10 years doubles at 7%. But if you have it for 40 years, only 4 times as long, it's up 15 times. So there's a whole bunch of growth. Now, obviously, this assumes that the market goes up in a nice straight curve, which it does not, as the previous index chart showed. The importance of low fees. I stress that it is important to keep the fees low because same kind of compounding. But I also do note that whatever statistics you see on official websites or prospecti are always after the fees have already come off. And I'm going to mention the word MER probably multiple times, management expense ratio. It is a fee that the mutual fund or ETF company takes in order to keep the lights on and to administer that mutual fund or ETF. You never see it go. It's not a line item on your statement. Markets do go up in the long run, as we saw on the index chart as well. They can have downturns, for sure. Those downturns tend to be at most 2 years long, except for the one that we had during the Great Depression. They tend to be 2 years long, which is where the 2 years for that cash bucket 1 comes from on the bucket portfolio. Okay. And so we talked about different strategies. So lump sum is you have a significant amount of money, $5, $10, $20,000, whatever that is to you. You buy a single asset one time. What most people do is they put the money in as they make it. So that's called dollar cost averaging. What that basically means is you're putting in the same amount of money month after month, quarter after quarter, however frequently you're doing it. And if the market goes down, then you're buying the same dollar value, but the shares are now cheaper, so you're buying more of them. So that's a sort of a protection in the downtrending bear market. But of course, whatever assets you've had up until then also go down. But you can sort of make yourself feel better that at least while things are down, that you're buying more of it. The other part of dollar cost averaging, which I have to confess, I've had multiple financial advisors over time, and they've never done this, and that's rebalancing, which means if I selected according to my risk awareness or my risk profile, I said I want to be 60% in stocks and 40% in bonds. And then after a year, I am now 75-25. What you do is you sell the disproportionately high to get back down to 60 in my example, and use that money to buy the disproportionately low to get back to the 40 that we were targeting. That does two things. One is you're selling high as far as your portfolio is concerned, and you're buying low as far as your portfolio is concerned. And rather than being more exposed than you're comfortable to stocks, in my example, you're able to kind of bring it back to where you're comfortable, right? That does have a positive effect on the returns of your portfolio, by the way. You're sort of doing the right thing. It could be quite difficult psychologically. It's much better if it's automated, or if the financial advisor does it for you. But like I said, I'm not aware of anybody doing it. And during the last session, somebody pointed out quite accurately that there are balanced ETFs and balanced mutual funds, which will do that for you. So if you don't want to touch anything, then you can just buy one of those products and you're good, and you're good to go. So that's sort of where we ended last session. I hope everybody's had time to sort of digest and think about it. Any questions about the material we've previously covered? I'm looking at the chat. No, typing furiously. Okay, so we talked about lump sum and dollar cost averaging. Another one, which is, I call it personal oversight. It's basically where you're trying to time the market, where you see something going, you're watching the news, and you're like, okay, I think this is what's going to happen. I hate to tell you, people are most frequently wrong. People usually do themselves a disservice by thinking that they can outsmart all the people on Wall Street and on Bay Street. But you know, if you want to try, here's some rules. You should be trying to sell when things are expensive. So if something's been going up and up and up and up for a long time, people keep piling in because it's FOMO, fear of missing out. But it's also greed. They think they're missing out on their neighbor, you know, the water cooler talk, or God help us, the taxi driver or Uber driver is telling them, oh, I made this much money. That's when things are about to drop. So that's not when you should be buying. In fact, that's when you should be selling, right? So that's when you should be fearful when others are greedy, as Mr. Warren Buffett says. You should be buying when things are cheap, when people are panicking and selling. I know it's hard. Oh, that's a gut check. When things dropped during the pandemic and everybody was panicking and selling, there were people who were buying on the other side, right? For every sale, for every seller, there has to be a buyer. And that's who made the money when the market came back. But not an easy thing to do, right? Which is if that's not your thing, just do the dollar cost averaging. But personal oversight is when you try to time it. By the way, some people might run 80% of their portfolio under a regiment like the dollar cost averaging, and then they have play money for 20% of their portfolio, and where they think that they can outsmart everybody. So you're basically making your own choices to outperform the market and all the experts. We all try it. Generally, it doesn't work for most people. I would suggest having some sort of an investment thesis and compare your portfolio to that thesis. So I'll tell you mine. It's just my own personal thing. I'm into emerging markets, where you have poor countries where there's a very large lower class, and they're being pulled up out of poverty into middle class. and they're going to want to, drive a BMW, play on an iPhone, drink a Coke, that kind of thing. Also, the developed nations have a fairly stagnant and old population. And so the developing markets, the emerging markets, they have a young population. And so that's where the growth is going to be. But that's just my own. Please get your own. Don't buy hot stock tips. By the time you hear about it at the water cooler, somebody's bragging about it. They're not trying to help you, right? Somebody who says, oh, this thing quadrupled for me. Yeah, that's the last thing I want to get into now. Because what are the odds of it, going up for a whole bunch more? So other strategies, just way of thinking about investing, and just to be aware of things, right? If you just sort of go in blindly and you just start buying, you have to have some sort of a strategy. So when markets go down, there's three things that you can do. You can sell, you can do nothing, or you can buy. So selling is generally the worst thing to do, because by the time you act, the market's dropped a whole bunch. And so you're going to be selling near the bottom anyways, and you're going to be locking in those losses. It'll generally throw your portfolio into disarray. So whatever it is that you were doing is now going to be in shambles, because you can't plan and you can't do it in an orderly fashion. Now, I personally have like 60 different stocks and 20 different mutual funds. I'm just not going to liquidate the whole thing, sometimes on a hunch. So selling is out of the question when the markets go down, because as you saw on the index chart, things go up over the long run. In the short run, you'll have these things. You could do nothing, which is generally what a financial advisor will tell you, because it requires the least amount of activity on their part, and the markets will come back. 6 months, 12 months, 14, 24 months, who knows? But the markets will come back. It's either that or our society's just taking a left turn. The best thing to do is to buy more, actually. So when prices are low and they're going to go back up, stuff's on sale, so you buy more. This is super easy to say and really hard to do. So so I'll tell you my strategy about the stock market, just as an FYI. I'm not suggesting it for you. This is because it involves borrowing. Okay, that's not for most people. So I just want to mention that. I have this blurb here because a friend of mine, who I'm sure is not on the call, was trying to time a purchase of a stock perfectly. The stock was going down a year and a half ago, and he's like, oh, it's still going down, still going down. And then it's like, oh, well, now it's going, oh, I missed it. Oh, so I made up this. This is copied and pasted out of an email, almost verbatim. So I am unable to time the market even reasonably, let alone perfectly. I will not be able to find the bottom to buy nor a top to sell. Okay. I stay invested at all times. I put spare cash into the market because the market goes up in the long run. So in 5 years, I'm still going to be up. I try to keep a small amount of cash as an emergency fund. That depends which month you catch me on. If there's a drop of more than 20% in the overall market, and let me say, this is not a if, this is a when. It will happen eventually. Nobody will tell you when that will be. They'll have lots of opinions. You listen to experts on CNBC and BNN, and yeah, they throw stuff out there, and this investor says, oh, we're going to have a 90% crash. No, we're not, but there will be a crash eventually. So if there's a drop of more than 20% in the overall market, I'm going to buy more using my home equity line of credit. So against my condo, I have like $150,000 line of credit. So if the market goes down by more than 20%, that's when I start buying. It could go down more, but I consider it enough of a trigger and enough of a discount. Because the market's on sale. It could go down more, but it's impossible to know where the bottom is. So I'm satisfied with that 20% discount. And when the market comes back up, I'm going to be, patting my own back. So that's sort of the strategy. Am I overwhelming everybody? Everybody's good? Is this kind of useful of how you're thinking about investing in the stock market? I'm looking at the chat again. Everybody's good and information and good. Okay, great. All right. Well, if you have any questions, yeah, let me know. This is for you, as I said. So we're going to get into account types. So this is RRSPs and TFSA and stuff like that. Okay. So it kind of has account types up here. So you have your RRSP and RIF, TFSA, registered educational savings plan, registered disability savings plan. Then you have various locked in accounts. And then you have a non-registered or a cash account. And then you have different vehicles. So you have cash, mutual funds, which we talked about, stocks, we've talked about bonds, exchange traded funds, private equity we'll talk about. REITs are real estate investment trusts. Those are, as the name implies, companies and stocks that invest in commercial properties, apartment buildings, mini malls, whatever it is. Resources, so that would be your commodities, gold, oil, that kind of thing, and then standalone real estate. So I put this in here because I talk to lots of people about investing, and I always say, so what are you investing in? I have some RRSPs is the answer. And that's not an investment, that's an account. That's up here. I'm asking about this. So basically, with the exception of not being able to hold real estate in your TFSA, you can pretty much do anything. There are some exceptions. Investing in business in which you hold more than 10% or higher in an RRSP is not allowed. Precious metals that are not gold or silver is not allowed in RRSP. Commodity futures, private holding companies, private foreign corporations, your own debt, personal property are all non-qualified investments for RRSPs. So some of these here would have asterisks. Okay, so which vehicle to use when? So generally, if you're doing a lump sum, if you're doing $5,000 or $10,000 at a time, even if there's a commission, which will be $10, it's a big enough sum that you can do exchange traded funds. If you are doing small purchases every month for dollar cost averaging, you should choose something that has no commissions. So either use a brokerage that doesn't charge you commissions on anything. So Wealthsimple is commission free for Canadian stocks and exchange traded funds. The different brokerages might have certain number of exchange traded funds which you can buy without paying a commission. Quest Trade lets you buy any ETF without a commission, but they'll charge you to sell. And mutual funds generally, with the exception of Quest Trade, once again, mutual funds you can generally buy without a commission. Okay, so let's talk taxes and account types. I know everybody's been looking forward to this. But in all seriousness, if you're going to set something up and you're going to run it for the next 20 years, do the research, inform yourself, and choose the right investments and the right accounts. Okay? Because you don't want to be 15 years into it and you're like, okay, well, I'm getting ready for whatever it is, retirement, buying a house, whatever it is. And it's like, oh, but now this is going to happen. And you don't want any surprises. So this is going to introduce us to RRSPs, TFSAs, and the non-registered or cash accounts. I'll probably call them non-registered though. So RRSPs, what confused me first was RRSPs are bought with pre-tax dollars, somebody would tell you, or it lowers your income, or it gives me a tax refund. And I'm like, okay. And then now this wasn't yesterday, this was 20 years ago. But so this is how it works. So if you're using pre-tax dollars, if your income is going to be $60,000 in all of these examples, and you're going to buy $10,000 worth of RRSPs. So if your income is $60,000, you buy $10,000. Your adjusted income is now $50,000. Let's say you pay 30% taxes. Your take home is 35. Lowering your income, sort of the same thing. 50 times 30% is 15. Your take home is 35. Now, the last one is sort of the most difficult, is it gives you a tax refund if you're using after-tax dollars for the purchase. So this is how it works. Income, 60,000, you pay 30%. So now you're paying 18,000. Your take home is 42. You pay 10 grand for the RRSP. Your cash left is 32. You're going to get a tax refund from that RRSP of 30%. So you're going to get a tax refund of $3,000. So your final is still going to be 35,000. Okay. They all work the same, but it just confuses people. So wanted to throw that out there. Now you want to be using an RRSP when you're near the top of your career, whatever that happens to be, whatever that happens to be. And then you're in a high tax bracket for you, and you want to use the RRSPs to lower your taxes. You absolutely have to be in a lower tax bracket when you're selling the RRSPs than when you're buying them. Okay. Otherwise, you lose out if you end up using RRSPs. So RRSPs will defer any taxes that are made on the money inside the RRSP until you pull the money out of the RRSP. So you have the RRSP bucket, money goes in, you get the tax deduction. Inside the RRSP, you can fiddle with it as much as you want, buy, sell. There's no tax implication. There might be fees and so on, but there's no tax implications within the RRSP. When you pull it out of the RRSP bucket into your checking account, then you get taxed on it fully. And I'll show you the tax table about what fully means. The limit that you have is used up when you make the purchase. Kind of an interesting thing that not everybody knows is that you can buy the RRSP today to start the compounding, to start the investment, but you can use the tax benefit in the future. So if you're having a slow year and it's not worth it to use the RRSPs this year, you can still buy them, and then you can use the limit later when you're in a higher tax bracket. Okay. Not everybody knows that you can carry it forward. Of course, you have to supply the money when you're buying it. So that's kind of the downturn. Okay. Everybody okay with the RRSPs? All right. TFSA. So TFSA is sort of the reverse of the RRSP. It's bought with after-tax dollars, but anything that you withdraw from it is, number one, tax-free. Everything inside the TFSA bucket also grows tax-free. But when you withdraw the money, no taxes. And what's kind of cool is that the limit recycles the following year, meaning you get whatever you withdrew, you get that back. And I did an example last session. If anybody wants one, we can do another example. So you would use the TFSA if you're starting your career and you're still in a low tax bracket, because it's not efficient to use up the RRSP room. And the low taxes that you're paying make it cheap to get that after-tax money in order to invest in the TFSA. Okay, if I'm opting to buy stocks in RRSP, can I buy and sell, or if it needs to be bought single time? So you put money into the RRSP, cash is in the RRSP, you buy a stock. If you sell the stock, you now have cash in your RRSP. No tax implication. Cash isn't growing, obviously. You can leave it as cash for a long time, and people do that. They want to get the tax credit, so they'll put in cash, and they say, "Oh, I'll decide later," and they'll decide 2 years later. So can buy and sell and should not day trade. RRSPs, I talked about last time about day trading in the TFSA, which is a no-no. RRSP, I think in RRSP you can do options. I don't think you can do all option types. This is a little bit more advanced, so apologies. As far as day trading in the RRSP, I think that's still okay, because whatever profits you make, ultimately you will pay taxes on when you pull it out. Again, phone the CRA or go on their website and double check. But because you will ultimately end up paying taxes on any proceeds, you can certainly, I believe you can day trade in an RRSP. As far as the options, I don't think you can do everything. I think you're limited to, I think, don't quote me on this, I want to say covered calls. I never had the inclination to do options in an RRSP. But yeah, good follow-up question. Yeah, most welcome. Please ask questions, guys. If something's not, if I skipped something or you have questions, I'm happy to go over it again. This is for you. Okay, so we talked about that. Okay, and then the last one is non-registered or cash account. So you might want to use a non-registered account if you're at the beginning of your career, so you're still in a relatively low tax bracket, and a TFSA has been exhausted. It's maybe not efficient to use to use up RRSP room now. You might want to do it later. That's when, if you've exhausted your TFSA, you could just get a non-registered account. Yeah, so the low taxes make it cheap to get the after-tax money to put into the non-registered account. Yeah, I would do this if you've exhausted the TFSA, definitely, and possibly the RRSP if you're in a higher tax bracket. So the non-registered account is bought with after-tax dollars. And anything withdrawn on it is taxed depending on what's coming out of it, whether capital gains, meaning that you bought it here and you sold it here, that's capital gain, so that's tax efficient, and you'll see in a tax table. And any dividends that are paid are generally, depending on what they are, could be taxed very low if they're Canadian eligible dividends, or very high if they're foreign dividends, which end up being taxed like salary. So we'll talk about a couple of pointers a little bit later on. Will that be, so the non-registered account, will that be taxed only when withdrawn, or capital gains every year? So that's a good question. For a non-registered account, you pay taxes only if you made money. So if you never sell anything, you don't get taxed for capital gains. If that asset is paying dividends, as you get the cash for the dividends, you will be taxed on that at that point for that year. But if you have paper gains and you haven't sold anything, then you don't get tax capital gains. Okay, but like I, for example, buy stocks that pay dividends. So I plan to hold those stocks for 20 years. So I'm not, and then I'll control when I get taxed on the capital gains by selling. But those stocks will pay dividends, so I will pay those along the way. Good question. Okay, so let's look at. I'll come back to this section, but I want to show you the tax table. So this is sort of a diagram of conceptually what to use when, and I've talked to people who said I always want to use a TFSA. I'm like, okay, I think there's a time and a place for everything. So the vertical axis is your earnings, how much money you're making, and this is over time. So you've just graduated university or high school, and you started out, but you have high hopes, and your career is going to do really well. If you're getting paid salary, you're going to accumulate RRSP room. I would argue you should not use it right off the bat. You should be buying a TFSA into a TFSA of asset of your choice, obviously, because you're in the low tax bracket. So you're paying little taxes in order to get the after-tax money that you purchased a TFSA with. And number two, using up RRSP room wouldn't give you as good a bang for your buck as later on. So it's better to save the RRSP room. And then, we all kind of feel it. Okay, this is about as high as I'm going to go. In my career, I've sort of hit whatever ceiling I'm gonna hit. And your earnings start to flatten out. Whether that's at $40,000 or $150,000, doesn't matter. Whatever you think you're reaching your top, then it becomes time to start using the RRSPs. You can still use a TFSA, that is no problem. And then you say, okay, I'm 55, 60, 65, whatever, I'm retiring. You can draw, your income drops. Notice you should be withdrawing, especially for the RRSP, when you're in the lower tax bracket than when you were putting the money in, okay? You can, this may not have to be a vertical drop. It could be more of a diagonal. That's if you want to keep working, for example. Okay, so opting for buying stocks, ETFs, US, Canada. What's the best investment to buy in all of the three accounts? What's the best investment to buy? I don't know you. I don't know what your risk profile is. I'm not going to give you a specific, I don't want to give you financial advice because I don't know you, and you could be, you could be 70 years old and need the money tomorrow. So putting you into a stock or something would be ill-fated. So I mean, I have favorites. I can tell you about those, but I'm not recommending them because they may not be for you. I like Canadian banks. They pay dividends, and they pay dividends, which I'll show you in a second, are taxed very favorably. And for foreign stocks, I end up buying stuff like Alibaba and Google and Amazon, stuff that doesn't pay dividends, because as I mentioned earlier, foreign dividends get taxed heavily. I'm quite tax aware, which perhaps too much, but it definitely affects how much money is in your pocket at the end. So those just grow, and they would be taxed when I sell them, and I'd be paying capital gains. But I don't know, that's just what I like. About half of my portfolio is in mutual funds anyways. My question is to know if I can buy dividend stocks in TFSA, RRSP, or non-registered. Yeah, I mean, if you have TFSA room, then buy dividend stocks in the TFSA and you won't pay any dividends on it at all. If you buy dividend payers in a non-registered, if they're Canadian eligible, which I'll explain what that means in a sec, then you'll get taxed very, very little on it, and you'll save your TFSA room. Jumping ahead a little bit to this paragraph, which I skipped, foreign dividend payers typically end up going into an RRSP because foreign dividends get taxed as salary as anyways, as does anything coming out of an RRSP. So it doesn't matter. And American dividends, there's a 15% tax withholding on the dividend itself. And so if you get a 4% dividend, you know, they'll end up dinging you 0.6%. In a non-registered account, they'll ding you, but then at tax time you get tax credit, so you sort of get it back. RRSP, they don't ding you at all, and in a TFSA they'll ding you the 15%, and and you can't get it back. So that's why foreign dividend payers end up in an RRSP. Canadian dividend payers you can have in a TFSA if you have room, or you can put them into the non-registers. So that's sort of that covers some of this. So we'll go through that in a sec. Let me show you the beauty that is the Canadian tax rate table, and then we'll go back up there. Okay, so this is a combined federal and British Columbia. So this is for my homeland. These are marginal tax rates. So let me be clear about what that is. If you are already making $50,000, if you make one more dollar, you're going to pay 28.2 cents on that dollar. This does not mean that if you're making $50,000 that you're paying 28.2% on all of it. You pay 20% on the first 42,000. So your average tax rate, if you're making $50,000, is probably 22, 23%, maybe even less, maybe 21. Okay, and there's a calculator for that, by the way. I found it. Okay, so this is combined federal and British Columbia. This is from taxtips.ca. Just Google marginal tax rates and find it for your own province. So here we go. Here's Canadian dividends. So these three columns are for non-registered accounts, and I'll explain why. Canadian dividends, if in a non-registered and if in a cash account, I get an eligible dividend. And an eligible dividend means the company is publicly traded. I think it has to be headquartered in Canada, and it has to be publicly traded on the Toronto Stock Exchange. Okay. The dividends that it pays are considered eligible. And by the way, I try to get a list of all Canadian eligible dividend companies, and one doesn't exist. And you go on CRA website and they tell you, go look at the investor relations tab for the company, and they should be telling you whether they're Canadian eligible. So as you can see, if you have no other income and you collect roughly $50,000 in Canadian eligible dividends, you pay zero taxes. Okay, so that's sort of what I was hoping for. And even as your income goes up, it is still by far, until in BC the break even is like way down here, versus capital gains is when you're making around 150 grand is when the capital gains become more tax efficient. Okay, Non-eligible would be if you own your own personal corporation. It's headquartered in Canada, but it's not publicly traded. So when, as an owner, you pay yourself dividends, they're non-eligible. They're taxed significantly higher than the eligible ones. At a certain point, capital gains fairly early on become better. But the other income, which is salary, is still absolutely the worst. So capital gains, again, in a non-registered account, is you buy the stock for $10 a share, you sell it for 15, you pay taxes on the $5 difference. And that is always going to be half of this column. So in this column is everything else that is not in these three. So your salary, your wages, interest, whether from the bank savings account or from bonds, that is all taxed here. Now, depending on whether you're a conspiracy theorist, you could be saying, well, the government is trying to screw people who work for a living, or you could be saying, well, they're trying to help out business owners and investors. They put money into the economy, they take a risk, so they should be given favorable tax treatment. You could also say it's for rich people. So depends on how you look at it. So other income is taxed the highest, includes earned interest. RRSP withdrawals. So that's when I said RRSPs are taxed fully. When you put them in, you get a discount in this column. You get that 30% I was talking about in my example, that is in this column. But when you pull it out, also in that column. So heads up. Foreign dividends will also get taxed here. So in a non-registered account, if you have foreign dividend payers, you'll get taxed in this column. So that's why people will just put it into an RRSP. They'll get the tax deferral, where those dividends grow tax deferred over years until you pull the money out. And when you pull the money out, it gets taxed here anyways. Okay. All right. So that I'm hoping that wasn't too technical. So when you make money, salary, wages, or whatever, that gets taxed here. If you get RRSP if you put money into RRSPs, you get the benefit in this column. RRSP withdrawals are in this column. TFSA, obviously no taxes, so that's not even on this table when you withdraw the money. And these three columns are on non-registered accounts. Okay, everybody's shell-shocked, I'm sure. So let's do some comparisons. So put any bonds in an RRSP or a TFSA. So why would you do that? Bonds pay interest, which gets taxed in the leftmost column, in the bad column. So if you put it in a TFSA, no tax implications at all. If you put it into an RRSP, it'll get taxed the same way as it would be in a non-registered account. So answering some of the questions I already had. Put any foreign dividend payers into an RRSP to avoid that 15% withholding on dividends, or into the non-registered account where you get a foreign tax credit at tax time. TFSA is going to ding you that 15% on the dividends, but you won't get credit for it or be able to get it back. Having said that, if you have TFSA room, don't let the tax treatment deter you. I'm just saying to be aware of all these little things. Use non-registered if the TFSA is exhausted, or if you're expecting losses. So the non-registered account has a superpower. It's the only account where if you lose money, you can use that to offset gains. So I put money into a non-registered investment. I lose money on it. I can use that money when I sell it. You have to sell it to get a capital loss. I can use that capital loss to offset other capital gains from other stocks that I've sold. If I sold an investment property, for example. So that's the only account that does that. If you invest in something in an RRSP or a TFSA that loses money, you get nothing. You get whatever's there. Nobody gives you any credit for it. So some people will put risky investments into a non-registered, that if it goes badly, that at least they'll get a tax loss, a capital loss. Other people will put big bets into a TFSA. So if it does do really well, it'll be tax-free. So other than the credit for the losses in the non-registered, a TFSA is always going to beat the non-registered because there's no taxes. RRSP will beat a TFSA if you're selling in a lower tax bracket than when you're buying. TFSA will equal an RRSP if you buy and sell in the same tax bracket. But you're ignoring that for the TFSA money to be invested in the first place, you have to pay taxes on that, while the RRSP you'll pay the taxes later. TFSA will beat the RRSP if you're selling in a higher tax bracket than when you're buying. Even a non-registered can beat an RRSP if you're selling in a higher tax bracket than when you're buying. Remember, RRSP, you have to buy in this tax bracket and sell in this one. Otherwise, it's a really bad idea. Especially if you're doing capital gains, because capital gains get taxed at half of what's coming out of the RRSP. Students should be investing in a TFSA or non-registered, not RRSP. So that's going back to my little diagram. RRSPs, interest-bearing investments in foreign dividend-producing stocks. TFSA should be growth or interest-bearing investments, and non-registered should be Canadian dividend producers or something high volatility, which could have losses. Okay. All right. Let's leave that alone. Okay, so we're going to get into some personal finance. I'm going to go for another half hour or so. It's going to be various topics. Just we'll see how far we get. In the Saturday session, I'll finish kind of the personal finance stuff. And there'll be some alternative investments, real estate, and we'll talk about stuff like that. So mortgages, first of all, a lot of people don't know the different types of mortgages. So just to quickly go over it, variable mortgages means that your interest rate will vary. So when the Bank of Canada changes interest rates, variable mortgages get affected. They usually have it'll be Bank of Canada rate plus 0.5% plus 0.25%, whatever. So when Bank of Canada raises, variable interest rates mortgage will go up. Fixed rate mortgages, as it implies, for the 5 years that you have the mortgage, your interest rate is locked in. They tend to be higher than the current variable, but if the variable goes up, then it'll surpass the fixed. Some mortgages have a way of converting that you're on variable, and then you can say, okay, I'm going to lock it in, then you flip it into fixed. You usually pay a slightly higher interest rate for the pleasure and the option of doing that. Okay. Open versus closed. Open just means you can put money in whatever you want. Closed means generally you can put in an extra 10-20% or whatever. Each one is different on the anniversary, but otherwise you're having to stick to the schedule. So if you get a windfall of some kind, you can't put it into your mortgage. Some mortgages will let you double up the payments and so on. But yeah, you should, when you go grocery shopping, when you go mortgage shopping, you should sort of know what bells and whistles you want and which ones would be nice to have, because trust me, they're going to make you pay in higher rates for all the bells and whistles. You can have great flexibility if you get just a line of credit, a home equity line of credit instead of a mortgage, but then you're paying a much higher interest rate, but you can put money in, you can take money out, a lot more flexibility, but you're paying for it. The banks know how to set up their products. You may wish to use a mortgage broker to kind of shop around for you as well. I mean, that's up to you. I would hit my favorite bank that I have the best relationship with, but it's not like the good old days where you would, talk to the branch manager that you've known for 20 years and they'll give you special treatment. Like these days, it's a lot more formula. You can always refinance your mortgage. You'll usually pay penalties. Usually it's 3 months of interest. That will be the penalty. And then you can obviously start a different one. So if you think interest rates are going to go up, might be the time to either flip yours to fixed, or do whatever you need to do. Kind of an interesting thing, variable rate mortgages get their interest rate from the Bank of Canada. Fixed rate mortgages look at the yield on the bonds from the government of Canada. So if you're getting a 25-year mortgage, whatever the yield is on the government of Canada 25-year bond plus some sort of a constant is what they'll offer you, and negotiate. Definitely try and shop around. Try to do it all together within a given period, because then your credit rating, which is what I'm going to talk about next, gets hit just once. But if you go look for one mortgage today and then in 3 weeks you get your credit checked again, your credit score takes a hit because it looks like you're shopping around for mortgage. So, okay, credit score. So credit score basically determines, you can also do blended mortgages, a fixed portion and a variable. Yes, absolutely. Yeah, you can do a mortgage where you have a home equity line of credit component as well. So, okay, let me back up. You can do a blended mortgage that has a fixed portion and a variable portion. So you don't have to choose one or the other or flip from one to the other. You can sort of, hedge your bets. You can kind of split the money 50-50, 60-40, whatever you want to do. You can do that. And another one that will give you some flexibility is you can get a mortgage that as you're paying down the principal, you are building a room in a home equity line of credit, in a HELOC. So at the beginning, the HELOC has zero, but as you start paying the principal down, suddenly you start borrowing a room in your HELOC. The HELOC will have a higher interest rate than the mortgage will, but you can now use that to invest. And this is also called the Smith maneuver, which I'm not really going to cover here, but borrowing to invest in certain types of investments will allow you to deduct the interest on the borrowing costs, on the borrowing. Is it possible to buy bonds in RRSP or non-registered from Wealthsimple or Questrade? So I have to confess, I've never bought individual bonds. I'm pretty sure you can. I don't know about Wealthsimple. Questrade, I'm very sure you can. you can put them into whatever account you want. Okay. I've always bought bonds as part of a balanced ETF or a balanced mutual fund. I've never bought individual bonds. You can put them into whatever account you want. It's just from a tax perspective, it's better to put them into an RRSP if you want to get the tax credit, because when the money comes out, you'll get taxed the same way. So you might as well put it into an RRSP. Check with the brokerages. Wealthsimple seems to be pretty limited. They may not let you do bonds. I don't know, but I'm sure that's an easy Google for both of them. So anyway, so you can get a mortgage where you start building up a room in a HELOC, which you can then use to to invest. Okay, so good questions. So credit score. Credit score is how various institutions, not just lenders or banks, your mobile. When I check my credit report, and I should suggest everybody should, by the way. Do I have? No. When I got a new phone plan, they checked my credit score. When I got home insurance, they checked my credit score. Like a lot of different, employers would have to ask you, but they wouldn't employ you if you said no, probably. You might have to sign something. Your landlord can ask you to check your credit score. So it's a good idea to keep it high. In Canada, it's between 200 or 300 and 900. Basically, you want it as high as possible. The things that play into it is the number of credit inquiries. That counts for 10%. The credit mix, and what that means is they want you to show that you're responsible with credit, basically. And they would like you to have different kinds of credit that you're showing responsibility with. Now, don't go and buy a car on a car loan just to get a better rating here for 10%. But if you have a credit card, if you have a mortgage, if you have a HELOC, if you have an unsecured line of credit, that's the sort of thing that they're looking for. But don't go and start paying interest somewhere just to get a slightly better credit score. Credit history. So the length and the age of your profile counts for 15. So yeah, like I got my first credit card second year of university to start having a credit tracking. Okay. I still have the same credit card. I mean, it's changed colors and probably banks, but I still have the same credit card. But what's equally important is the payment history. So if you're 19 and you're getting that credit card, then make sure that you're paying it off every month. We'll talk about that in a sec. And yeah, credit utilization. So that counts as 30% of your credit score. And what they're looking for is that whatever limits you have, that you're no more than 25 or 30% using up all of your credit. Like they don't want you to be up to here. Then that really hurts your score. Okay. So depends on who you talk to. Like I listen to Dave Ramsey, who's a radio personality. He's in the US, and he's absolutely anti borrowing anything except for your primary residence. And so that is way too much. He says, no credit cards, buy everything for cash. And his audience is people who are in debt. And if they have a credit card, they're going to max it out again and not be able to pay it. So I understand why he's saying that. However, I buy what I need and I pay it off every month, and I'm comfortable borrowing to invest, which we'll talk about in a sec. So I'm good with credit cards. If you have credit card debt, do not be investing, because the credit card interest is at least 10, 15, maybe 20, and on some 30%. There's absolutely no way that you're going to get a guaranteed 30% return or 20% return on your investments after taxes, because that's what you're paying into your credit card interest. So don't even think about investing until you've paid off your credit cards. But if I'm paying 3%, me personally, I'm comfortable to invest with borrowed money. Please make sure that you look inside yourself and kind of understand the risks. It amps up the risks when you're borrowing to invest. But going back to the credit score, if you shut down a credit card, it'll hurt your credit score, because one, you lose the credit history, and you'll also lose the credit limit. So your credit utilization is going to jump up. So it's kind of funny. The credit score prefers people who have a bad credit history and are a known quantity. Like we know that you're bad. We're going to charge you more interest, or we're going to lend you less money, or both, or not lend to you at all. But at least we know what we're looking at, rather than somebody who's 20 who has no credit history because they're a completely unknown quantity. So credit history is important, and so you end up losing the payment history. You get dinged on the utilization, and so actually on 3 of these you could say. Okay. So if you have 15 cards, yeah, you should probably shut most of them down. If you have 3 and you're paying them off every month, then you're probably good to keep them. Consumer debt, I think I've already beat credit cards to death. I kind of look at them as chainsaws and scissors and fire. If you're using them properly, they're helpers. If you're using them poorly, you could be losing, to go with the chainsaw example, you could be losing bad things. So be careful with credit cards, and only spend enough that you can pay off, like live within your means. Okay, pensions. Okay, should it be used more than 2 credit cards in different banks? I don't think it matters if your credit cards are with different banks. So the question is, should you be using more than 2 credit cards in different banks, I think. So it doesn't matter whether your credit cards are with the same bank or different banks, I wouldn't think. Your bank might like you more, but as far as credit score, I don't think it matters. Like I confess, I have 3 credit cards. I have one kind of that's general, that gives me air miles, that I'll default to if I don't use it. If I don't use the other 2. The other 2 give me well, one gives me cash back. So I know what to use it for, like restaurants will give me 2% cash back, so I'll use it there. And then the third one is a PC Optimum, so I will only use that at the superstore only. I have never used it anywhere else, and so I get the points, which translates to cash off my grocery bill. So I've sort of done it as I've seen fit. The one that gives the 2% cash back, I've chosen one of the categories. It's a tangerine. Not that I'm advocating or selling it. I've chosen the appropriate categories, So like repeated expenses. So, my whatever automated bills I have every month, I use that credit card for, so I get 2% cash back. So I've sort of arranged it that way. I don't want to get any more. But yeah, I mean, having at least one credit card is a convenience. You don't have to carry cash around. You pay for something and you don't have to pay for it for up to a month. Plus, you'll get some points. But what they depend on is for people paying only the minimum monthly amount or not paying at all, and then they can charge them huge amounts of interest. That's how the bank makes money. And of course, they charge the retailer 3-4% for the transaction as well. So I think it's actually MasterCard or Visa that makes that 3 or 4%. So you have to use it responsibly. If you want to have five, have five. I don't think you need that many. Like I have a specific reason for each one. Nobody's ever become a millionaire on points either. So keep that in mind, right? Like generally all the points translate roughly to 2%. Now, I liked air miles about 10, 12 years ago because BMO would let you buy a $100 investment voucher off your air miles. So I bought a $500 mutual fund using air miles and then a crisp $100 bill because I didn't have enough air miles for the minimum of 500. And then whenever I built up more air miles, I added to it. And now that mutual fund, my friends, is worth $1,200. And I basically out of pocket, I paid $100. So yeah, they don't have that anymore. I'm sad. So I hope that answers the question, Tao. Credit cards, if you use them badly, are really bad, like really bad. Okay, pensions. So I talked to a friend of mine who's nearing retirement. He's like almost 60 now, and he's worked in one place his entire life, and we're talking money as I do, and I said, what kind of pension do you have? And he says, I don't know. I'm like, well, when you get a statement, what does it say? I don't know. So there's two kinds generally. Defined benefit is usually reserved for government, unionized jobs, teachers, nurses, that kind of thing, where you pay into it, but they will promise to pay you a certain dollar amount per month once you start the pension. So you get a defined benefit, as the name implies. This is really only for government because it's the employer that takes the risk. Okay, because they're responsible to pay you a certain amount. Unless the employer, of course, goes bankrupt, like Sears, where a lot of people were upset because their defined benefit pension was in the bankruptcy. So a different one, and I'm not going to say better or worse, even though generally you could say it's worse, is defined contribution. So that means the employer might be putting in money, you might be putting in money, they could be matching yours. Every employer will be different. But when you get a statement, it says you have $150,000. And so if the stock market goes badly, you have less money. The employer, other than putting in the money in the first place, doesn't have to make up the difference. Of course, if the stock market does really well, then you might come out ahead compared to a comparable defined benefit. So if you were working permanent somewhere, I would suggest check your HR booklet, talk to your HR person. If your statement says if you retire at 65, we're going to pay you, I'm making this up totally, we're going to pay you $1,100 a month. Then you have a defined benefit pension plan. If it says you have $150,000, that's a defined contribution. Okay. Defined contribution has that risk. Defined benefit should be safer. You might consider in your financial planning as using it as a safe version of income. You might not. Different people suggest different things. Okay, we've got about 10 minutes left. If you guys stick with me for 15, I can get through insurance. Okay, nobody's gonna bail on me. Sure, okay. I can't see everybody. Okay, so let's go through this. I think this is an important personal finance thing. So let's talk about life insurance first of all. Life insurance should only be for people who have financial dependence. This is completely non-argument. I don't care what your insurance salesman tells you. Your 1-year-old child should not have life insurance, no matter if it costs 25 cents a month. Only if you have financial dependence, meaning if you pass away, somebody is going to be harmed financially. Not they're going to be sad, they're going to be harmed financially. So, you know, what's an example? If my parents are financially self-sufficient, for me to get life insurance and name them as beneficiaries when they don't need the money is basically, if I were to die, and it's like, well, you win the lottery, your son's no longer with us, but here's all the money that you didn't need. Like, there's no point to it, right? So there's different versions of this. The one that all the experts, like all of them, say that you should get is term life insurance. It's only life insurance, it's cheap, the premium is fixed during the term, that's why the name is term. When you renew, let's say in 10 years, you're older, you're generally going to be paying a higher premium. The amount that you should insure yourself for is enough to pay off the mortgage, and 10 times your annual salary should be the benefit. So if you have two parents working and there's some children, there's a mortgage, if one of them were to pass away, there would be financial harm to the other and the children, then this is sort of the benefit that you should aim for. Okay. You could say 5 times salary, you could say 20 times salary. I mean, that all depends on you. There you go. Now, you'll hear different ones here. So whole life, permanent, universal life. They all have an investing component. They all have an investing component. They allow a cash value to accumulate, and they last a lifetime. That's why it's permanent. They don't expire after a term because you have money in it. The cash value can be accessed at a high rate of interest, and there's generally low rates of return. Universal life also has a component, an investing component, also has a cash value. There's a death benefit. So it's always a little bit of life insurance, the cheap part, and then you're paying in a whole bunch and that gets invested for you. The problem is that investment is usually, and I don't want to make blanket statements, I'm going to, but please, please, please whenever there's an investment component in a life insurance policy, check the numbers, because I am going to show you something magical. Okay, so I actually got this about 4 years ago. And when I say got this, I got pitched this. And so here we go. So I'm putting in $1,000 a month. So each year I'm putting in $12,000. Okay. Here's my age. Here's the years. The total benefit on death. Now, this was especially inappropriate for me because I don't have any financial dependence. So even though life insurance was completely useless to me, but we'll leave that aside. So here's the total account value, and here's, if you want to get out, here's the cash value. The two are pretty much the same. To be honest, I don't know what exactly is the difference between the two. I have to confess. There isn't a significant one, as you can see looking down the two columns. Okay, so let's say for the first 5 years, I put in $60,000. Now, they were telling me, now this was running on top of a mutual fund of some kind. And they say, okay, well, let's assume that you're getting a 6.25% return. Later on, it switched to 6.75. Again, I'm not sure why. But after 5 years, 12 times 5, so 12 months times 5 times 1,000, so that's 60,000. At 6.25 should be worth 70,000. I look here, it's worth 61. So I'm like, what happened to the 10,000 or roughly 2,000 per year? Well, that went for the life insurance. I'm like, really? That's really expensive life insurance. Because for where's my the death benefit for somebody non-smoker my age, like, you're not paying a heck of a lot for this. Maybe $40 a month. So let's say 500 a year. What happened to the other 1,500, right? They're like, okay, hold on. If you keep this going, I'm like, okay, so let's look at 20 years. So after 20 years, that comes to 240 deposited at 6.25. That should be 475. Okay, 430. Where's the 45,000? So still about 2,000 per year is missing, right? My death benefit went up. Okay, like that wouldn't be enough to pay even, a typical mortgage in Vancouver, frankly. So I was always down 2,000 a year. So if you're ever pitched this, take a look, okay, and do these sorts of calculations, please. Maybe there's good ones out there. After a long time, they sort of start to break even. You may not have to make any more deposits, but they've had your money for a very, very, very long time by then. And if you had stuck that money in the stock market and just bought the term life that you needed, all the experts say you would have done better. Just please check your numbers. Now, here's some of the things that the salespeople are going to tell you. There's tax deferred growth. So yeah, you don't pay any taxes on it because you're not pulling any money out. Just like within a registered pool. So they'll compare this to a TFSA. They'll say you've run out of TFSA room, you can get this. But it accumulates in a tax exempt manner, just like any investment though, until you sell it. Like I can have a non-registered account with stock and it won't charge me any, like there won't be any taxes on it until I sell it. You won't actually need to pay any taxes on this because you're underwater compared to the amount of Well, no, you're not. No, you put in after 20 years, you put in what was it, 240,000, and it's worth twice that. So yeah, there is some capital gains. Now, you would only get this money if you close the policy. Then they would give you your $430,000. But each year they took their $2,000. They took their $2,000, which is in my case is 16%. If you close this policy, I would be very curious about the capital gains on this. So potential tax-free during retirement. So trying to get a loan against the cash value. So this was kind of the nail in the coffin for this for me. So the salesman says, well, listen, you can keep this growing. You can keep the money in there, but you can sort of borrow against it, and you can take the money out. I'm like, okay, cool. What's the interest rate? And it was prime plus 5. So it was like 9%. I'm like, that's a hefty interest rate. And he's like, oh, okay, don't worry about that. People will pay into this their whole life, and then when they're ready to retire, they can use the cash value to borrow against from their bank. I'm like, okay, cool. So I phoned Coast Capital, which is my credit union, and then on a different matter, I also talked to Royal Bank. And Coast Capital said, I've been working here for 20 years and never have I done a loan against cash value of one of these policies. And Royal Bank said, no, none of the big banks do it. Now, a friend of mine said that there are organizations that will work with you. I would be very curious as to the interest rate. Okay, so yeah, so tax-free income, yeah, you'd be borrowing at a hefty interest rate. Tax-free distributions upon your death to your beneficiaries, yes, of the life of this column, of the death benefit. But here's the funny thing, depending on the policy, and if you don't pay extra, this cash value, actually, if you die, goes away. So double check that if you have a policy like this, or if you're thinking of getting one, double check that. If you pass away, do you only get the death benefit, or do you get the death benefit and the cash surrender value? I think in a lot of policy, you'll only get the death benefit, and in other policies, you have to have an extra rider on the policy in order to also get the cash value out. So careful. And this is what worries me, is that people pay into this their whole lives, and they might not know that, you know, they'll be charged an exorbitant interest rate when they finally want to start using this money. Like it's unfortunate. Okay, so yeah, read the fine print and ask lots of questions. Okay, so that was we're in the home stretch here, folks. Home stretch. So disability insurance is if you can't work anymore. It's usually expensive, but you get ongoing payments. So you might say, well, can you replace $40,000 a year? And then they're going to charge you a lot. Like I looked into them, and it ended up being like $200 a month or something like that. Like it was significant. But that's if you're disabled and you can't work. Critical illness, if you catch one of 30 things, they'll give you a one-time payment. So that one's cheap, but they'll give you, I'm making this up, 50 grand. And so, yeah. So we covered life insurance, we covered permanent life insurance, we covered disability. I want to talk about segregated funds, but let me say something a little odd first. I think, and I don't mean to sound harsh or make this sound bad, but insurance is really for poor people. And before I see in the comments, what I mean by that is everybody should be trying to be self-insured. If I can't work anymore, I can live off my investments. You know, if a family has $10 million and the breadwinner passes, they're fine. Uh-oh. Can I withdraw my money from insurance anytime if I need? Can I withdraw my money from insurance anytime if I need to? I would think that it would depend on the insurance. A term, I wouldn't think so. I don't think so. Check with whomever sold you the insurance. For the permanent or whole universal life, yeah, you should be able to. Yeah, you should be able to. They'll make you obviously pay interest. They might put the interest payments into the amount of money that they give you every month, for example. But yeah, from the permanent life insurances that you put extra money into, you should be able to pull it out. If you want to get all of your money out, then you would have to collapse the entire permanent life insurance. I don't know if you can get anything off of term though. So that would be something to ask the broker or whomever. Okay, yeah, good question. I don't think for term you can use it as collateral, but I'm not 100% sure to be honest. Okay, last but not least, you're most welcome. Last but not least, segregated funds. So segregated funds are an insurance product, but they're very closely tied to a mutual fund. The universal life up here, by the way, these could run on top of some sort of a mutual fund. They could be telling you we're paying you dividends. There could be some sort of a schedule. Different companies run them different ways, and they have tons of products. For segregated funds, based on the name, I actually traced the segregated fund to the underlying mutual fund. Okay. So it's a mutual fund with an insurance wrapper. So what does it do? Well, it bypasses probate. So probate is when you die. It can take anywhere from 4 months to 12 months for a court, even if you have a will, but with a will it's faster, for a will to verify the will. And if you don't have a will, to divvy up your assets to, children, parents, whatever it is. And the assets are locked up. So you might not even have money for a funeral. So sometimes, or quite often, segregated funds are sold because they bypass probate, meaning whoever the beneficiary is of the segregated fund, they get the money right away. So the segregated fund runs as a mutual fund. If the owner passes away, the beneficiary gets the money right away. If the owner stays alive, which, fingers crossed, because it's an insurance product, just like life insurance, it is not accessible to creditors during bankruptcy, which sounds good. But then again, if you have money to invest, are you in danger of being bankrupt? Now, each one of these segregated funds has a number like this. It could be 75/75, 75, 100, 100, 100, and so on after the name. Now, in addition to whatever MER the mutual fund is charging, the segregated fund will have another 1 to 1.5%. So if the mutual fund is charging 2% already, they could, the segregated fund, depending on these numbers, which I'll explain in a second, could be, the MER could be 3 or 3.5%. Okay, so the 75 in this instance, but it could be 100 depending on which one you choose. It means that the premiums invested are guaranteed at maturity. So that means that if I put in $10,000 and there's usually a maturity period, usually about 10 years. And if you keep the mutual fund or the segregated fund for that long, and during that time, if it went from 10,000 to below 7,500, the mutual fund company will bump you up, in this case, to 7,500. If this number was 100, they would bump you up to 10,000. But of course, then this additional MER would be higher. Now, this maturity it sort of keeps you locked in. You can definitely get your money out earlier, but then you lose the guarantee. And by having this maturity period, that keeps you paying that 3.5%, 4% MER for 10 years. But people like my mother think you can't lose, right? If it goes down, they'll bump it up. There's no problem. A couple of problems. Number one, you're losing to inflation, if nothing else. But here's the other thing, and this might sort of tie everything we've been talking about together a little bit for you. In a given year, I'm going to make these numbers up, but you'll see the progression. In a given year, the stock market goes up 60% of the time, down 40% of the time. Over a 3-year period, it's up 70% of the time, 30% down. Over a 5-year period, 80-20. But like with one exception, there is no major index that after 10 years is down. The one exception is after the dot-com crash, the NASDAQ index, which is all technology, and it was all the dot-com companies. It took 12 years to recover back to, so it would have to have been the absolute worst timing for something to be down after 10 years. So they're insuring you against something that will not happen, right? They're insurance companies. They know how long you live on the average, and they can look at the historical numbers and see how investments do. So they give you this guarantee, they lock you in for 10 years, but it doesn't happen. Okay, this other one may be a little bit more applicable. Japan index has been down for a long time below, okay. But that's not something you wouldn't, yeah. So somebody's saying Japanese index, okay, yeah, they've had a decade. But if you look at North American stocks, TSX, S&P 500, Dow Jones, like none of these, like it doesn't happen, right? Okay, Japan, maybe you could find something else, right? But especially if this number is 75, like, you know, it would have to be down 25%. So anyways, it's calculated to make money for the mutual fund company is the bottom line. Now this other number is if you pass away, then that's the percentage of premiums invested is guaranteed at death. Now that would be prior to maturity. So if you buy this, the market tanks the next day and then you die 3 months later, they would bump it up to whatever this number is. So this might be a decent selling feature to somebody who's 80, but unfortunately these things get sold to 20-year-olds, and they're very, very unlikely to pass away. and they're still going to be paying those high MERS. And it might be a much better idea to, if you want to set aside money for your funeral, just whoever your family is, just give them $10,000 and say, this is for my funeral, rather than buying products like these. Okay, just give it to somebody that's not going to be caught up in the probate freeze, and you know, pick somebody responsible, not, you know, obviously, but like the executor of your will. But so, you know, and then the salesperson says, yeah, but people don't actually do that, and so they end up buying these questionable products in order to kind of have these things happen. But it's the insurance companies that end up making the money. So on that somber note, I'll tease you for Saturday, which is our next the 27th. We're going to talk about becoming financially independent, and I have some pointers and some rules of thumb, which I'd like to share with you. Any questions on kind of anything we've covered in the last two sessions? I've gone way over time. I do apologize. I hope this has been useful. Any quick typists? Okay. All right. Looks good. Well, I hope that's been useful. I hope to see everybody. I actually can't see anybody. I hope to see everybody on Saturday for the third one. So that's going to be, I think that'll be the most interesting, is how to become financially independent. And we'll talk about some alternative investments. Up until now, I've really been in the realm of stocks, mutual funds, and ETFs. And on Saturday, we'll talk about real estate, which I do have some experience with as well, and some other alternative investments, and you know, good books to read, that kind of stuff. So I'm going to stop my sharing, and I hope to see everybody on Saturday. All right, have a pleasant evening.